Welcome to Access Granted, the podcast sponsored by XChange Place. XChange Place is an online investment platform designed to give access to issuers and to investors alike. Issuers, those who want to raise capital for a project, for a company, for a real estate deal, for any type of investment opportunity. We want to provide access to as many people as possible. And for investors, we want to bring access to different investment types that they wouldn't normally be able to see or to have access to. Democratization of investment opportunities, that's the goal. In this episode, we're going to talk about structured notes. There's lots of material in the literature on structured notes. There are YouTube videos. A lot of people like them. Some people don't like them. We'll talk a little bit about that. But the goal here is not to just create another video onto about structured notes. The goal is to talk about some of the things that we're going to try to do at XChange Place, similar to structured notes with some twists, and see if they're interesting for anybody. Structured notes are usually debt instruments issued by financial institutions like banks. They generally have some form of principal protection, either 100% principal protection or some high percentage principal protection, as well as being linked to the returns of an underlying asset. In this case, we'll talk about the S&P, for example, as an underlying asset. So what the structured note is designed to do is to give investors some comfort about their principal, but also giving them some exposure to the upside of a particular asset class, like the stock market or the S&P. There are generally two types. They're generally known as growth or income. Growth is just designed to participate in the upside of the asset. If it's a stock market or commodities or any other type of asset, structured notes that are considered income notes actually provide a certain coupon or yield with some other caveats, assuming certain things happen in the market. But basically, they're tailored to a certain exposure that people want to get. So why some people like them, some people don't. Some of the positives are they can be convenient. They allow investors to express a certain view. They can be somewhat complicated. But I think the reason some people don't like them is there are invariably a lot of embedded options, and to a sophisticated option trader or derivative trader, I think they would likely argue that the options are not priced to the advantage of the investor. They may be either expensive or cheap and priced to the advantage of the issuer. That being said, not everybody has access to those efficient option markets, so in some cases they may actually be okay for investors. But let's talk a little bit about structure and how we get there, and an alternative to a structured note issued by a financial institution. In this example, let's assume we create a vehicle, a fund, a pooled investment vehicle, and part of the investment capital purchases 5-year zero coupon bonds. The approximate yield is 4%, which would give the zero coupon bond a price of about 83%. And I'm just rounding off these numbers, and they change every day based on interest rates. So this vehicle is pretty likely to at least have enough to pay investors back par at the end of the 5 years, because the treasuries will mature at par. And in the absence of some very unlikely event, the custodian fails or some other type of risk, it's pretty likely that investors will get their principal back. Now, having spent, in this case, $83 on the Treasury zero coupon bonds, there's $17 left. Those $17 can be spent buying the S&P, buying S&P futures, buying some other stock index, buying commodities, pretty much anything that an investor wants exposure to. But it's really just arithmetic. What's invested in another asset will appreciate or depreciate. If it depreciates, then investors can expect to get their principal back from the treasury bonds. If it appreciates, investors will get a net return that's really a blended return of 4% on the treasuries and whatever the underlying asset earns. So one of the things to consider is that it's unusual for most investments or most asset classes to make enough money on a $17 investment to make the blended return out of 100 something that's appealing to investors. Now, here's where what some people call the bells and whistles come in. Investors can or structured notes can have different options. There can be leverage on the investment, so there could be leverage on the stock market or leverage on any other asset. Of course, that increases the potential that that asset gets wiped out within the 5-year period. There are also different variations of structure, barriers, buffers, catapults, and others. In some cases, for example, a barrier is where investors have principal protection unless the stock market goes down more than 30%, in which case they take the risk of the stock market decline. Now, an investor can take that view and feel comfortable that the stock market may not go down 30% in this 5-year period. But that's a pretty valuable option for the financial institution to have. So you can see why the bank-issued structured notes can actually lean towards the advantage of the bank. But in the case where it's treasuries, then it's very easy to understand what's happening with the other $17. As I said, most assets are not going to yield enough on $17 to make the blended return reasonable. But what really comes to mind when you think about very high-yielding type of assets, which also have potential risk of complete wipeout, venture capital or seed capital or early-stage companies, they generally have probably the most upside. And of course, in some cases, if they don't work out, they can be worthless. So we think that's an area where there is the opportunity to use this structured note type of product to give people access to a risky type of investment class, but also giving them protection on the downside. So XChange Place hopes to take this concept and bring forth a number of really interesting deals. There's one that will be coming up shortly, which we call the Secured Investment Fund. You can think of this as a hedge fund or any other type of pooled investment vehicle. It's designed to act like a structured note. So the appropriate amount would be spent on zero-coupon treasury bonds to give investors a lot of comfort that they'll get their principal back. Again, there are some extraneous or tangential risks to custodians and other mostly unlikely types of risks. So investors can feel comfortable that they have a good shot at getting their principal back. And with the discount, the $17 in this example, it would be invested into XChange Place assets, which would be purchased, securitized, fractionalized, and hopefully distributed through the platform. And this is designed to provide investors the options. Instead of investors selling away options, we've done this to try to create something where the investor has the option and the investor can decide what they want to do, and they can decide at the maturity, so they know what they're getting into. So at the end of 5 years, the outcomes will consider the following. We expect that principal will be returned from the treasury bonds. And then there are a series of options that the investor has to effectively put back the investment in XChange Place assets and to receive approximately a 12% annualized return. So in that sense, it's like an income structured note because investors were targeting a 12% return for investors at the end of 5 years. They put back their shares and they can walk away. Now here it's also as an income type of structure. It's also structured with debt protection. If the company doesn't have enough to pay that blended return of 12%, then investors actually get issued a lot more shares and effectively get a good percentage of the majority of the company. So you could think of that as a debt-like structure where if the company can't pay its obligation, in this case 12% annualized, then investors can effectively take over the company, and whatever that residual value is gets added to their principal. Of course, management believes that we've got a pretty good shot at getting to the 12% yield, or we wouldn't necessarily be doing this. We also want to give investors the option to treat this like a equity or a growth structured note. So at the end of 5 years, if the company's doing extraordinarily well, investors don't have to put it back, and they don't have to take their 12% return. They can actually stay in and keep the equity, and in retrospect, it'll be as though they made a venture capital deal with no principal risk and maintained all the upside of that transaction. So we think this is an interesting structure for investors to consider. I'm not here trying to sell securities. I'm just trying to outline this concept and this structure. If anybody is interested in this, they could go to the platform. They can read the documents and all the disclosures, review all the risks, and see if it's something that fits them. So one of the things that comes up is, why does an investor need me or XChange Place to buy treasury notes? They really don't. You can do the treasury notes on your own, or you don't have to do the treasury notes. But I think it's instructive at this point to talk about a concept that's extraordinarily important in finance called the Sharpe ratio. Some of the most sophisticated strategies there are use Sharpe ratio and think about Sharpe ratio all throughout the day. And it's relatively simple. It's just the excess return divided by risk. Risk is generally considered to be standard deviation, or the volatility of the price of the asset. There are other definitions of risk, but for the moment, we just look at excess return. In other words, the return over and above the risk-free rate divided by the risk. Now, you many times hear about assets as being uncorrelated, and that's a positive thing for an investor's portfolio. And that's true. The reason uncorrelated assets are important is when you put two assets together that are uncorrelated but may have the same risk or volatility, the blended volatility will be lower, so the Sharpe ratio is increased. Another way to think about Sharpe ratio is that you can take an asset, and you want the asset with the highest Sharpe ratio, because if it has a very high Sharpe ratio but not a lot of return, it may not be acceptable to an investor in terms of return, but the risk is very low. So you may actually find that you can leverage that security to get the return that you want and get to a certain risk level that's acceptable. By the same token, another asset may have a high Sharpe ratio but may have more risk than you're willing to accept. You can actually take that asset, put it together with some cash in a portfolio, and reduce the risk. So you reduce the return and the risk to a level that's acceptable. So basically, assets with higher Sharpe ratio are generally better assets than lower Sharpe ratios, because you can either use some cash or use some leverage to get to the risk return profile that you like. So in this case, we've created this fund so that we're basically using the treasury bonds to dampen the risk. The venture capital investments that we're going to be showing you, or the early stage fund investments that we're going to be showing to you, will have risk. We don't necessarily think they're going to go to zero, but they will have some exposure. And by putting them together with the treasuries, we think we're going to help investors get to a return profile that fits their risk-reward requirements. So that's it for the first episode. Thank you for listening, and we'll be back with another topic soon.